Welcome back to Financial Market Insights for Traders. I'm Sophia, and today we are having a serious, in depth conversation about something that is shaping nearly every corner of the financial world right now: Fed policy in 2026 and what investors should expect. If you've been watching the markets this year, you already know that the Fed policy impact markets 2026 isn't just a theme, it's the theme. Every rally, every pullback, every rotation between sectors seems to trace back to one central question: what is the Federal Reserve going to do next? So today, I want to walk you through this carefully and thoroughly. We are not going to skim the surface. We are going to unpack where policy stands, what inflation is really telling us, how the labor market fits into the picture, what interest rate scenarios are realistic, how different sectors respond, what the bond market is signaling, and how global markets are reacting. And most importantly, we'll talk about how you, as a trader or investor, can position yourself intelligently in this environment. Let's start with the backdrop. Earlier in the decade, the Federal Reserve launched one of the most aggressive tightening cycles we've seen in modern financial history. Inflation had surged, and policymakers responded by raising interest rates rapidly and shrinking liquidity through quantitative tightening. Fast forward to 2026, and while inflation has cooled significantly from those peak levels, policy rates are still elevated compared to the ultra-low era many investors grew used to before 2020. That matters, because higher rates change everything. They change how companies borrow. They change how consumers spend. They change how investors value future earnings. And that's exactly why the Fed policy impact markets 2026 remains such a dominant force. Right now, the Fed continues to describe itself as data dependent. That means there's no fixed roadmap. Each decision hinges on incoming information: inflation data, employment numbers, wage growth, consumer spending, financial stability conditions. Every major economic release becomes a potential catalyst for volatility because markets are constantly repricing expectations before the Fed even acts. Let's talk about inflation first, because that's still the core of the entire conversation. Headline inflation has moderated, but when you dig deeper into core inflation, especially services, you start to see why policymakers remain cautious. Housing costs are still sticky. Healthcare expenses haven't fully normalized. Energy prices can swing unexpectedly based on global supply disruptions. Services inflation, in particular, tends to move slowly and persist longer than goods inflation. If inflation stays stubbornly above target, the Fed may hold rates higher for longer. And that scenario has clear implications. Elevated bond yields could continue to pressure high-growth stocks. Financial institutions might benefit from stronger net interest margins. The US dollar could remain firm, influencing commodities and multinational earnings. On the other hand, if inflation convincingly trends downward over several months, markets may begin aggressively pricing in rate cuts. That shift alone could spark rallies across equities, high-yield credit, and even emerging markets. But here's the key: markets don't wait for the first cut. They move on expectations. So often, by the time the Fed actually pivots, asset prices have already adjusted. Now let's bring the labor market into the conversation. The Fed's mandate isn't just about price stability. It's also about maximum employment. And in 2026, the labor market remains relatively resilient. Unemployment is low, though we are starting to see signs of gradual cooling in certain industries. Wage growth is moderating but still strong enough to keep policymakers cautious. Wage growth is particularly important. If wages rise too quickly, businesses may pass those costs on to consumers, which can reignite inflationary pressure. However, productivity improvements, especially driven by automation and artificial intelligence, could offset some of that pressure. If productivity rises while wages stabilize, inflation risks diminish, and that opens the door for more flexible policy. Every monthly jobs report now has the power to move markets significantly. A strong payroll number can push yields higher and pressure equities. A softer report can fuel optimism about easing. When we talk about the Federal Reserve interest rate outlook 2026, we really have to think in scenarios. One scenario is that rates stay elevated for much of the year. In that environment, borrowing remains expensive, mortgage rates stay high, corporate refinancing costs remain elevated, growth stocks may struggle with valuation compression. Investors might rotate toward defensive sectors with stable cash flow and strong balance sheets. Bonds could offer attractive income, but capital appreciation would depend on yield movements. Another scenario is gradual rate cuts. If inflation trends lower and labor markets cool modestly, the Fed may begin easing cautiously. That typically supports equity markets, especially technology and growth sectors that are sensitive to discount rates. Bond yields could decline, improving total returns in fixed income. Credit conditions might loosen, encouraging investment and expansion. But we can't ignore the third possibility: policy miscalculation. If the Fed eases too early and inflation resurfaces, credibility risks increase. If it tightens for too long and growth stalls sharply, recession risks rise. In a downturn scenario, you could see equity corrections, defensive asset rotation, widening credit spreads, and increased demand for safe havens like gold. This is why understanding how Fed policy impacts different asset classes in 2026 is so critical. Technology stocks are particularly sensitive to interest rates because their valuations depend heavily on future earnings. High discount rates reduce the present value of those earnings. Financials, meanwhile, often benefit from higher rates, but only up to a point. Excessive tightening can slow loan demand and increase default risk. Real estate remains highly rate sensitive, especially residential markets tied to mortgage costs. Commodities respond not only to domestic policy but also to global growth expectations and dollar strength. And we cannot overlook the bond market. The bond market frequently anticipates economic turning points before equities do. Investors are watching the yield curve carefully. An inverted yield curve often signals slowdown expectations. A steepening curve may suggest improving growth prospects. Real interest rates, inflation expectations, and credit spreads all provide clues about underlying economic momentum. If you're actively trading these shifts, having the right tools becomes essential. A world-class, cutting-edge, user-friendly trading platform app can help you track real-time macro developments, analyze charts, and execute efficiently. If you're looking for that kind of infrastructure, you can explore the Crystal Ball Markets platform at crystalballmarkets.com/platform and see how it supports informed, strategic trading decisions. Beyond U.S. borders, the global market reaction to Fed policy 2026 is equally important. Because the dollar is the world's reserve currency, Fed decisions ripple across emerging markets, commodity pricing, and global capital flows. If the Fed tightens while other central banks ease, the dollar strengthens, which can pressure emerging economies carrying dollar-denominated debt. If the Fed eases while others remain restrictive, capital may flow abroad in search of yield. Fiscal policy also plays a role. Large government deficits can push bond yields higher due to increased issuance. Political uncertainty can increase volatility and risk premiums. Monetary policy doesn't operate in a vacuum. So what should investors actually do in this environment? Preparation beats prediction. Diversification remains powerful. Maintaining liquidity allows flexibility when opportunities arise. Focusing on strong balance sheets and sustainable cash flow reduces vulnerability to tightening conditions. And perhaps most importantly, staying educated helps reduce emotional decision-making. If you want ongoing, beginner-friendly conversations around trading, investing, macroeconomics, and financial markets, I encourage you to listen to the Crystal Ball Markets podcast at iss.com/podcast/crystalballmarkets. It breaks complex developments into practical insights you can apply immediately. As we move deeper into 2026, one thing is certain: Fed Policy Impact Markets 2026 will continue shaping valuations, volatility, and investor sentiment. Whether rates hold steady, begin to fall, or shift unexpectedly, disciplined investors who understand the macro landscape will be better positioned. That's it for today's deep dive. Thank you for spending this time with me on Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next episode. Stay informed, stay disciplined, and trade smart.